Debt markets continue to navigate a dynamic environment shaped by inflation trends, interest rate expectations, fiscal developments, liquidity conditions, and global macroeconomic events. As investors look for clarity on the road ahead, understanding the factors influencing bond yields and fixed income market becomes increasingly important. To help us decode the current debt market landscape and the key themes that could be driving the market movement in the next few months, we have with us Mr. Abhishek Bisen, Head Fixed Income at Kotak Mahindra Asset Management Company Limited. Welcome to the show, sir.
Thank you, Asta.
So, interest rate expectations have shifted significantly over the past year, right? What is your current outlook for debt markets?
Well, Asta, there are two parts to the question. One is internal, other is external. While external world has been creating volatility, but internal world is also equally important, especially from inflation point of view. Monsoon was a key risk some time back. However, monsoon is covering up the entire country, and it was expected to be a close to a drought kind of situation, which would have impacted food prices significantly. However, it appears that it is covering up the country fairly okay. Water levels have been satisfactory vis-a-vis the expectation. Therefore, monsoon-related risks have abated significantly. Now, coming down to the external world, it is volatile. If you look at oil prices, oscillating as low of 70 and again back to 100 now, going back to 90 and so on and so forth. So there is volatility around the world. But having said that, it is abating. Therefore, things are encouraging as far as rates are concerned. Markets are pricing in significant amount of tightening, which may not get delivered. And if at all, if there will be something, it will be only towards later part of the year.
So, is inflation still the most dominant factor for debt investors, or other variables such as growth, fiscal dynamics, liquidity conditions, global interest rate trends also becoming equally important? Also, tell me, what are the macroeconomic indicators that investors should monitor closely for the next few months?
Well, it's a good question. So the way it works is most of the indicators are important at all point in time, but there is a predominant driver for which takes the driving seat and influences interest rate decisions significantly. And this time around, while other factors are equally important, but balance of payment or current account deficit and currency related issues are in the driving seat. And as we speak, what RBI chose to address the situation with FCNR and other measures, which were clearly non-monetary, and therefore, and it has worked well as well. We have collected so far about $32 billion worth of FX in the FCNRB scheme, and we are just at not even midway in the kind of timeline which has been given. Therefore, we believe that they are likely to achieve their targets in FCNR collection of around $75 billion in total. And over and above that, if there is Bloomberg index inclusion, the flows can be much better than what it has been anticipated. So that risk gets covered with this, and therefore we anticipate that this key factor, while it is important, but may not be able to impact the way markets are faring in terms of interest rate movement.
So, what could be the biggest catalyst for a meaningful move in bond yields from current levels?
As I explained you in the previous question in terms of index inclusion and FCNRB flows, so there are twin impact. FCNRB flows are clearly going to impact the shorter end of the curve. Index inclusion, if at all it happens, the flows which are going to come in, they are likely to impact the longer end of the curve. And therefore, for entire yield curve, there is something or the other. And overall, we believe there is possibility that there may be some amount of flattening in the yield curve, and therefore duration category clearly gets benefited out of it. But eventually, it all depends on other factors as well. If oil prices remain elevated, markets will be scared. But if oil prices also support, there can be meaningful move on the longer end of the curve.
So, looking at the current market environment, is it more favorable to go for duration strategies, accrual strategies, or maintain a balanced approach?
Yes. So, given the kind of volatility, there is merit to be in a balanced or a shorter end. But risk reward basis, the way things are, one can look at duration strategies as well. But at the end of the day, it depends on your investment objective and risk appetite. So, what we are recommending to investors is given there are other factors which can suddenly drive away and take away hijack the entire situation. So, the shorter end, which has got value and reasons to perform, a balanced approach where you can have a little bit of both. So you get something from the longer end as well. At the same time, you are relatively safer because most of the time investors come for reasonable amount of safety and stability from the fixed income. Therefore, the strategy works very well.
Now, please tell us, how should investors think about debt allocation as a part of their overall portfolio strategy today?
So again, fixed income supposed to give you stability. If you recall what happened last year people were gung ho about equities and commodities because of the performance, and debt was coming somewhere in the last order and not at all expected to deliver anything. However, it turned out to be debt delivered one of the best returns in the overall portfolio. Therefore, existence of debt just cannot be ruled out because of either tax ineffective or other way around in giving low single digit returns. Sometimes that returns offer significant amount of flexibility to a portfolio and great amount of stability. Therefore, you must look at debt as a portfolio stabilizer and use it judiciously in such times where there's huge amount of volatility.
Now, what would be your key message to the investors trying to navigate uncertainty in the current times?
As you know, we are in a clearly a extremely volatile world and unpredictable at the same time, what we call as VUCA. You must be very careful about extreme euphoria or pessimism, and you must use both the ends for reclassifying your portfolio. And again, at the same time, debt is offering reasonable amount of risk reward for various kind of investors, and therefore one must use debt in order to stabilize the portfolio and make your portfolio much more robust for tackling this kind of volatility in the overall financial markets.
Thank you so much, Mr. Bisen, for joining us and sharing your insights on the evolving debt market landscape. Your perspective on inflation, interest rates, bond yields, and key macroeconomic developments helps the investors understand better the factors that influence fixed income markets.
Thank you.
While market conditions may continue to evolve, staying focused, informed, and aligned with one's investment approach remains important. We hope this discussion helps the investors navigate debt markets with more clarity. For more such information, stay tuned to Kotak Mutual Fund.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.